Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you're joining us for the very first time, a massive welcome to the community. My name is Bryce, and today we have a massive episode. To chat through it, as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. We are talking all things Aussie media today.
Yes.
Because, God, there is a lot happening there.
There is.
We are going to cover off our mid-year awards. We're in a new financial year. We're in July, and we're going to look back on the last 6 months and say who's done well, who's done poorly, what's surprised us, and what's shaping up for the rest of the year.
Yeah.
And then finally, we're going to close out the episode with the latest Pimp My Portfolio. Luke Laretive is going to be joining us. We're going to be unpacking one Equity Mates community member's portfolio. So a massive episode.
Massive episode. Cannot wait. Well, let's get straight into it.
News and markets.
Australian media. A lot going on.
Look, sometimes the headlines come thick and fast, and it makes you think, God, we're in a bad industry.
Yeah, I know. So, Ren, this week we've come to a close for what has been an ongoing saga or story, I would say, for a good 6 months or so, if not a little bit more. And that is with Channel 10 and Paramount. It's finally been bought, or the deal is done.
Yes. So I love it how we are using Channel 10 to make it an Australian story, but it is purely an American story. Paramount Global, one of the biggest Hollywood production studios and owner of a number of cable TV stations, Nickelodeon, Comedy Central, a whole bunch, and also happens to be the owner of Channel 10 in Australia. They have been getting shopped around. Different people have tried to buy them. And it is the culmination of a decade and a half long saga to take control of Paramount Global as Sumner Redstone, the man who sort of amalgamated it and built it, died, and his family fought over it, and it was a whole saga.
Yeah.
Literally, we read a book on it earlier this year.
Yeah.
But it has been resolved.
It has been resolved. So there's a film production studio called Skydance. I think it's just Skydance Pictures,
Media,
something like that, yeah. Who is owned by the Ellison family, and that name may ring a bell because Larry Ellison, the fifth or thereabouts richest man in the world, founder of Oracle, his son runs Skydance,
yes,
or owns Skydance. And so they've merged with Paramount and subsequently bought out the business.
Yeah, in essence, it's a little bit more complicated than that because the controlling shareholder of Paramount Global was this cinema chain called National Amusements, and they've bought National Amusements. But the long and the short of it is Paramount Global has a new owner.
Yes.
There is arguments that there were better bids out there, i.e. Apollo's $26 billion bid.
Well, we haven't actually said what the deal has been worth.
Well, in the end, Skydance will pay about $8.5 billion.
Yeah, crazy.
Yeah. They'll pay about $2.5 billion to buy National Amusements. That will give them control. Then they'll buy out a number of shareholders with another about $4.5 billion, and then they've committed to putting $1.5 billion into Paramount's balance sheet. So that is all very exciting in the US, but really how it's going to affect us here in Australia, because I'm going to hazard a guess, not many Aussie retail investors were investing in Paramount Global. It hasn't exactly been a shining success story. Channel 10 is in the sights.
Yeah, well,
it's the only thing that's protecting it now is it's such a small part of the Paramount business. Yeah,
it's forgettable.
Yeah.
Well, they're obviously going to look at this and want to rationalise some assets, you would imagine, to turn this into to improve the business, and Channel 10 will be on the chopping block. They're already battling.
Yeah. In May this year, they cut The Bachelor and The Masked Singer.
Two of your favourite shows.
Two of my favourite shows. Who's singing right now? The Bachelor, God, it had its time. It was a point of viewing. I remember when we were at uni down in Canberra, it was like people would be going around to houses and to watch
100%.
The Bachelor.
Yeah.
It was appointment TV.
Yeah.
It's not anymore.
Not anymore, no.
So Channel 10, apparently its revenue has been pretty stable, but it is a loss. It loses money every year. And so there is a question about what happens to it. There's not a lot of strategic value for Paramount Global in owning the third largest Australian TV network. So expect things to happen there. A number of media analysts have come out and said Australia can't sustain 3 free-to-air TV networks. And you'd think Channel 10 will probably get sold, but does it exist by the end of the decade? If I had to predict it, no.
You predict Channel 9 and 7 remain?
Honestly, not in their current form, but yeah.
What's your favourite?
7. Because they got the footy.
Yeah, I don't even watch the footy on 7 though. Or KO. Yeah. Love Island on Channel 9, that's for me.
Haven't got into it.
Speaking of Channel 9, let's keep moving because there was some pretty significant... Channel 9 has been going through some pretty significant layoffs over the last number of months, or the 9 group.
Yeah, and they've just announced another round of layoffs.
Yeah, so this one was pretty significant. It affected their pedestrian group. So they have, it's pedestrian group which has licensing agreements with other publishers like Vice, Refinery 29, Kotaku, as well as a number of other smaller ones.
Gizmodo, Lifehacker.
Yeah, so they're obviously really struggling in this environment. And as such, this week it was announced that they're going to be laying off almost half of the staff at Pedestrian and stopping all of those licensing agreements with those other publishers. So, it's not good news for small publishers here in Australia at the moment. Yeah,
they also, I was reading one report that they think a number of Nine's newsrooms will be shut down as part of this restructure.
Between 4 and 5, which is pretty significant.
I read 5, but I think that's just an estimate at this stage. Yeah. So that's happening, but that's not all that's happening at 9 because there's also reports of brewing strike action from unionised workers at Sydney Morning Herald, The Age and Australian Financial Review because pay negotiations have stalled. So that's another challenge that 9 has. But this layoff, 9 aren't alone because we've seen earlier this year both News Corp and Channel 7 also announce layoffs. So it's
tough.
It's not good out there.
Yeah. It's a tough environment, mainly being driven by the advertising market at the moment.
Yeah.
I guess we're right in the thick of it with being a small publisher as well, so hence why we're starting the show.
Yeah. Now, what you'll hear and what we have heard from these big media bosses is it's Meta's fault, and a lot of the announcements of their layoffs coincided with the government inquiry around social media and the end of these content partnerships that Meta had. Reports were that 9 got about $15 million over 3 years from Meta, and Meta have said we're not doing that again. We'll just we don't need you.
Again, small fry.
But look, the rot was deeper than Meta. Meta was a band-aid over a deeper structural issue in Australian media. Ironically, it was kind of caused by Meta and Google taking all that advertising. But the one thing that always annoys me with this conversation is it wasn't... Google and Meta are the big players in the advertising market, but they are not the ones that dried up the rivers of gold. The structural rot in Australian media happened about 10 years earlier. The rivers of gold in Australian media were the classifieds. And so, seriously, if we're gonna say what led to this decline in news, it's realestate.com, Seek, car sales. Those are the businesses that saw the most lucrative parts of media and said, we can take this revenue. And take it, they did.
eBay? Would eBay count?
Maybe. But look, media is in so much trouble in Australia and around the world. We haven't really spoken about 7 that much. 7 seems to be doing the best of the 3. But I pulled up some numbers from their latest half-year results because they are talking about the overall market. In 2023, gross total TV market advertising spend fell 11% in 1 year.
Wow.
So, like, money is just leaving TV. And this is probably the most illuminating point from Seven's half-year report. Revenue share of 41%, up 1.7 points. So they're taking market share from their competitors. But their total TV market declined 9.1%. Their advertising revenue from TV fell 7%.
Wow.
So they're doing the best. They're taking market share
in a declining
but still
market.
their advertising revenue is falling.
Yeah.
And that is the story of Australian media. There's just the pie is shrinking. Yeah, global media.
Yeah. Challenging environment.
So why did we quit our jobs to do media?
So the moral of the story is, if you're listening, thank you for supporting Equity Mates. Please continue to listen so that we can continue to publish content that helps you on your investing journey. Because this obviously all flows. I think for those that I guess want more insight into how it works, like that those numbers, they're the ones that suck the most revenue. And then it all kind of just flows down further and further and further, right down to the little players in the market.
Yeah.
So if it's not good at the top, then it's becomes more challenging the further down you go.
Yeah.
But we'll keep an eye on this one. I think from memory, one of your bold predictions at the start of the year, outside of the Channel 10 merger, was that there would be a major consolidation of a media network?
No, I said there would be one sale, and I said then that's too obvious, and so I said there'd be two sales.
Yes.
So we've had one.
Yeah.
We kind of all knew that Channel 10 was going to happen.
Already in
the one media company that seems to be bucking the trend and is worth paying attention to if you are interested, or the one big media company, is the New York Times. Up 28% in the past 12 months. They are the only ones that seem to have nailed the subscription model. And to be honest, nailed is a generous term. They seem to be surviving.
They've nailed their games. But let's leave it there and we'll move on. Well, Ren, we are halfway through the year. We've just kicked over into July. So we thought we'd do a bit of a wrap just to remind ourselves of where markets are at. There's been plenty going on.
Yes, we're calling it the mid-year awards, but this is really just a reflection on what has happened in the past 6 months.
Yes. So let's start with the markets. I guess to sum up, it's been a pretty good 6 months.
Surprisingly good.
Yeah. The S&P 500, the major market over in the US, is up 17%. The ASX 200, our market here in Australia, is up 2%. The FTSE in the UK is up 6%. The StockX 600 is up 8%. That's mainland Europe. The Nikkei is up 23%. That's Japan. The Hang Seng is 5%, which is Hong Kong. And the Nifty 50 is up 12%, which is India. So globally, we are seeing major markets up.
Well, my big takeaway there is nothing is down.
Did you look at Brazil?
No, I'm not saying that no market in the world is down. I'm saying you just did a roundup of 7 major markets and none of them were down.
Yeah.
So I think for a lot of people feeling cost of living pressure, reading a lot about the macro environment and interest rates aren't being cut and inflation is still high, people, you're looking at politics and you're seeing the rise of the far right in France. You're seeing Trump looking like he's going to win. You're seeing Biden forgetting a lot.
Who he is.
You would think that economic turmoil, political turmoil would see the stock market fall as a result.
Yeah.
But this is the classic example of why it is near impossible, I would say is impossible, to time the market because it is just so unpredictable.
Yes.
So that's the first reflection for the first half of the year.
So let's have a look at some of the best performing stocks now that we've looked at the markets. And we'll start here in Australia. Now, this is just out of any listed company, it's Macro Metals.
Yeah.
Now, this company is up 1,200% in the last 6 months. It is a small micro cap. It's only got a market cap of 94 million. I'd never heard of it.
Well, what it does, it owns an iron and steel project in Nigeria.
Okay.
This is the classic Australian mining company, like explorer or junior developer exploring somewhere far from our shores. Yeah. So we said, all right, maybe let's, you know what? Congratulations if you invested in Macro Metals. You've more than 10 bagged your money in 6 months. But we said, let's have a look at companies over 500 million. Where have been the best performers, the best stories? And there are some notable names in here. Number one, unsurprisingly, Drone Shield, up 353%.
I was at a concert on the weekend and where was it? Was it a concert? Anyway, I was somewhere and someone random just started talking to me about Drone Shield and I'm like, okay, here we go.
Okay.
It's on. We've hit retail.
Oh, I mean, yeah. I'm more surprised that someone recognized you.
No, we were friends, I think.
Oh, right. Oh, okay.
Yeah. I'm trying to remember where it was. But anyway, it was surprising that they were talking about Drone Shield.
Yeah.
So I'm like, yeah, it's hit mainstream.
Is that a sell signal?
It's hit mainstream. No, I reckon it's a... no.
Okay.
No.
All right, some of the other notable names. Mesoblast, up 225%. Clarity Pharmaceuticals, up 157%. Superloop, up 136%. And Zip, up 135%. Now, we should shout out that if you haven't listened to our conversation with Michael Frazis, it's worth listening to. It's in the Equity Mates feed now. Clarity Pharmaceuticals is now his largest position in his portfolio. So if you want more information on that one, go listen there. But some notable names.
Yeah, good to see. A couple of them we've spoken about on the show. Let's turn to the worst performers though, and hopefully none of these are in anyone's portfolios out there. This is again above a 500 million market cap. So the worst performer is Liontown Resources, the lithium miner that had such an incredible run last year. Almost got bought out and then got absolutely foiled by Gina Reinhart coming in and buying up 9.9% or whatever it was. Unfortunately, it's down 46% year to date, closely tied to the lithium performance. Strike Energy is down 41%. Domino's Pizza down 39%. IGO down 38%. And Sims down 34%. So a couple of recognisable names there. Pretty heavy when you consider that the ASX is up 2% year to date.
Yeah. So a quick look overseas, just to round this out, and then we'll get into some of the biggest surprises and worst investing takes. Best stock in the US, above 500 million market cap. You might be thinking NVIDIA, up 156%. You might be thinking Supermicro, that was up 187%. But no, it's Gene DX Holdings, up 890%.
Wow.
So almost 10 bags. I had a look at it.
Gene therapy?
Gene... like mapping where hold on, this is
like you can find out your ancestors and stuff.
No, more you can measure your own genomes. You can like map your own, you can sequence your own genes.
Gotcha.
That's what I was trying to say.
Gotcha.
Yeah.
Gene sequencing.
Yeah.
Okay, so it's up 190%.
No, 890%.
Sorry, 890%.
And then the best stock globally, which is actually still in the US, but it's traded on over-the-counter markets, Olavida International, up 1,432%. It reported a 3,000% increase in revenue year on year. It kind of seemed a bit spivvy, I've got to say. Yeah. It was like, it's like water-free cosmetics.
Water-free?
Yeah,
right.
Which, is good, but just the vibes the company was giving off when I was reading about it, I was like, But anyway, people have more than 10 bagged their money on that stock. So there's some of the numbers and some of the names, but let's get into what has really caught our attention and what is worth paying attention to for the next 6 months.
The biggest reflection over the last 6 months has been how wrong predictions have been.
Okay.
How blatantly wrong, but also how ashamedly, is that the right word? People are just changing predictions on the spot.
Oh, yeah. Classic. Yeah.
Classic.
Yeah. Give us an example.
Okay. AMP chief economist Shane Oliver.
We're calling people out.
He predicted 3 rate cuts this is in January.
Yep.
Predicted 3 rate cuts in Australia in 2024, specifically calling out a start in June. So we would have already had one by now. He said that rates wouldn't go down as fast or as far as they had risen in recent years, but was very confident that we would see 3 this year. Now couple that with the market expecting 6 rate cuts in the US.
In the US, yeah.
In the US, starting from as early as June as well and flowing through until the end of the year. Now, if you were sitting at the start of the year and making investment decisions on that and really thinking about how the year's going to play out, like how wrong have we been, have those predictions been in a 6-month period, yet look at the performance of the market, look what you would have missed out on if you hadn't have invested or if you, I think just you can't pay attention to these predictions.
Yes.
Like just, and I just find it fascinating that some of these, it's their jobs to make these calls, like chief economists of banks, et cetera, et cetera. And I'm my
motto with predictions is people don't make predictions because they know, it's because they're asked.
Yeah, exactly. But like they're paid to do it.
Yeah,
it's amazing.
Yeah. Well, no, he's paid to be an economist, and people ask him for predictions.
Yeah, but is that feeding into like?
Yeah, I know.
You know what I mean? But yeah, I think where to from here as well. Like, I think if you look at what people are expecting to play out over the next 6 months, particularly here in Australia, it's going to be fascinating to see where we finish the year.
Well, I expect, and this is a prediction, so it's obviously not worth the paper it's written on, but I expect we'll end with 1 rate increase, and that's probably.
At least,
I
reckon.
Yeah. You wouldn't expect we're going to be down from here.
No way. Not a chance. I also think it's been interesting, everyone's saying huge divergence in the Magnificent Seven at the start of the year. Sort of has played out in part, but some of those big tech companies have just continued to rip. I think if you look at people also saying NVIDIA was done, it's a bubble at the start of the year, up 157% year to date.
Still could be a bubble.
Still could be, but like I think what I always have in the back of my mind is, I think if maybe you'd said it or someone along the line, is that trends in markets always last a hell of a lot longer than you think. So if you were to, it's just interesting to see how it's all playing out. What about you?
So that was one that trends always last longer, and the amount of times people will have asked, have I missed NVIDIA? Have I missed Drone Shield? Have I missed the recovery in smaller tech? And all of them just double again from when that question is asked. The challenge is at some point the music stops, and you've got to be mindful of that, have stop losses, or keep a close eye on some of these fast-moving names. But God, trends last a long time. I think perhaps not my biggest surprise, but something that is notable is crypto falling away.
Yeah.
There was just like, and look, I bought into this as well. There was just like an irrational level of confidence that there would be a halving, there would be a small dip, and then it would rip again. And maybe it will. Maybe I'm just too early on this, but it certainly hasn't.
Well, the crypto bulls will say that the sell-off that we're seeing now, so I think Bitcoin's down about 25% from its high a couple of months ago or whatever it was. And the Bitcoin bulls will say, it's playing, it's meant to do this, blah, blah, blah. But I feel like they were expecting a run a lot earlier than it is now. So, I do agree with that. Putting it on notice.
Oh, you're putting Bitcoin on notice.
I'm putting Bitcoin on notice.
All right, well, we'll pay attention to that. And I think, my biggest takeaway as we sort of look ahead is the best time to be in the market was 20 years ago. The second best time is now. It's like if you were an index investor, chances are you're up, despite all of the reasons that you'd think the market has fallen. If you're an individual stock investor, there's been so much opportunity in growth recovery, in a number of, more stable value stocks doing well. Like, if you're waiting on the sidelines, probably think about your investing strategy.
Yeah. And if you're overexposed to the ASX 200, have a look as well.
Yeah.
It's one of the weakest performers. But anyway, we will take a quick break, and on the other side, we will be back with a Pimp My Portfolio. Well, it's time for...
Pimp My Portfolio. Pimp My Portfolio.
That's right. It is that part of the episode where we bring in an expert and a community member to get their portfolio pimped. And we have in the studio with us Luke Laretive from Seneca. Luke, how are you?
Bryce, Alec, how are you?
Good.
And we have Sally. Sally, welcome to Equity Mates.
Yeah, thanks, guys. Excited to be here.
Well, thank you so much for submitting. So, Ren, to kick things off, what have we got in Sally's portfolio?
Yeah, so Sally's portfolio is made up of 10 stocks, the largest weighting being BHP at 28% of the portfolio. After that, we've got Commonwealth Bank at 14%. The smallest weighting, to give you an idea of position size, is Woodside at 3%, so nothing smaller than 3%. I reckon Luke's going to like that. But some of the other stocks that are in the portfolio: Australian Foundation Investment, Flight Centre, James Hardie, NAB, Origin, Westpac and Webjet. So some big Aussie names in that portfolio. Luke.
All right.
So as we always like to start, we like to get a nickname, and then Sally will ask you how this portfolio came to be. But Luke, what have you got nickname-wise?
All right, this one's called Grandma's Greatest Hits.
Wow.
Sorry, Sally.
Wow, Sally, how do you respond to that?
That cuts deep, man.
All right, well, Sally, before Luke keeps talking, how has your portfolio come to be?
Sorry, Sally, I'm sorry.
Listen, no, it's all good, mate. Listen, to be honest, it's sheer dumb luck. I think I got, that, and you're dead right. Got some old school advice and went, if you're going to invest in shares, BHP.
Yep.
Most of these have been a one-off. Have just been cash I've thrown at them. A couple with the banks and the Webjet, stuff like that. Was COVID. I saw them just hit rock bottom and I went, they've got to improve from here. And yeah, I don't know, just every now and then I dabble in them, and then I don't know, pick one that's good. The JHX, the James Hardie, was pretty much the only one that I actually kind of did a bit of research in. Got them at a good price and they've done well. So, they might be grandma's picks, but I think I've done all right.
That's all that matters. If grandma's making bank, everyone's happy.
Nice. All right, Luke, well, with that context in mind, what are your initial thoughts?
Okay, so let's just go through the stuff I own, and that's pretty much just saying I think it's good and you can own it and it's worth holding. We'll talk about portfolio weights and stuff in a sec. So we own BHP. We're underweight though, so that's kind of like a sell from us. We kind of have to manage the index because we're trying to beat it. We just bought James Hardie recently, so we like that. We're super high conviction Webjet. You can, if you Google Luke Laretive and Webjet, you'll find lots of stuff about
You see it pumping the stock?
Yeah, about my thesis on Webjet and why I like it. We covered it in the Seneca YouTube quarterly thing, and we've got some Westpac as well floating around. So outside of those four, I've got 27 other companies in the ASX 200 that I'd rather own than the stuff in your portfolio. So that's my thoughts on the stocks in a quick 10 seconds. In terms of building a portfolio of direct shares, I know, BHP and CBA seem safe or whatever, but you shouldn't really buy anything more than 10, maybe 15 if you really want to get aggressive percent of your portfolio in a single stock. Maybe just keep that in mind. I think 1 or 2% as the bottom weight is fine, and then the stuff in the middle should be like 3s, 4s, 5s, 6s, 7s. That's sort of how you should do it if you want to run your own direct portfolio. But to be fair, it doesn't sound like you want to. Sounds like you're just sort of throwing darts at the dartboard and hoping something sort of sticks and stays.
Pretty much.
Yeah, and look, that's like a lot of people. So don't feel bad. Like, what's better than what you've done is running a proper process. What's worse is doing nothing. I think the fact that you've made a start, you're saving your money, like you're trying to invest in stuff that's going to do well for you. You're thinking about, investing in household names, stuff that hopefully you at least have some concept of what they do. Like, it's not all bad. I sort of come in here sometimes and get a bit like wacky with the stick, and it's, it's not necessarily all negative. That being said, I did want to use this as an opportunity to talk about AFI in particular. And I want to talk about listed investment companies in particular, because for all the grandma portfolios out there, they are all full of listed investment companies, whether it's WAM, AFI, Mirrabooka, Argo, there's lots. They are not a good way to invest your money. And I can categorically say that.
Oh, look, you're preaching to the choir here with Bryce. It's a gripe of his for years.
So they are businesses that are an active manager. So just think of it, there's no difference paying me, just paying Jeff Wilson or whoever. These businesses, instead of buying $100 worth of shares and getting $100 worth of shares, you get some number higher or lower, depending, whether it's trading at a discount or a premium. Further to that, these managers have what I call trapped capital. So, you give them $100 to manage, and they take that $100 and invest it in shares. If you want to sell $50 worth of shares, they don't sell $50 worth of shares. You sell your $50 worth of units to somebody who wants to buy into that portfolio. So that means the fund manager, when they do poorly and everybody wants to sort of get out of that fund, all of a sudden you're trading your units at a steep discount to fair value because everyone wants to get out, and vice versa. When they're doing well, everyone wants to get in. You've got to pay a premium. And so to me, when you've got an open-ended version of the same sort of products,
which is an ETF.
An ETF or an active manager, normal fund manager, anywhere, me, an SMA like what I run, you punish the fund manager by taking your money off them and their fees go down. You incentivise the manager to get you good returns by giving them more money, and their fees go up that they earn. In these LIC structures, there's no incentive to do the right thing by investors. So as a result, their returns are absolutely rubbish. And I went and had a look at the top 10 ETFs, listed investment companies on the ASX. There's $25 billion tied up in these listed investment companies, and all but one of them over the last 12 months has underperformed. All but one of them over the last 6 months has underperformed the Vanguard Australian Shares ETF, and over 10 years, one beat it by 28 basis points. So next to nothing. Now, you'd be doing much better than both of those things if you were in one of my products. Now, I can bang on about my products till the end of time, as you guys know, but we'll save that for another day. But my point here is that if you can get into an active fund where a manager's got a good process, charges a fair fee for a fair service they deliver, that's great. If you don't want to do that and you want to buy an ETF, go and buy an ASX 200 or ASX 300 following index ETF for, how much are they? I don't even know these days.
0.04 is the cheapest.
4 or 5 basis points, and you're going to be getting it for 1/6 of the price of AFI. Sally, you've only got a small percentage of your portfolio in AFI, but I just wanted to use this as an opportunity to educate the audience more broadly about listed investment companies. And for you, Sally, something that you could think about is, over time, new contributions, just choosing a broad-based index ETF or an active manager if you want help doing that. The reality is that that's going to get you a share portfolio without you having to guess, and you're probably going to get better returns than you scattergunning and crossing your fingers and hoping it comes back in 20 years and it's all gone well.
Yeah, I think...
Rant over.
I think to echo something that Luke was saying there, Sally, is because a lot of your positions are some of the bigger Australian companies, BHP, the banks, it does sort of look like some of the bigger companies in a ASX 200 or ASX 300 ETF. So have you thought about ETFs as part of your portfolio?
Yeah, listen, and only recently I've kind of jumped back on the bandwagon of, doing a bit of research and obviously listening to you guys a fair bit and, reading Morningstar and so on and so forth. And I'm not overly savvy with this stuff, but ETFs have been... something that I want to kind of get into and have been considering. And I have been kind of considering selling a lot of that stock that I've got now anyway. Exactly as what you guys said, I think a lot of it's kind of outdated and it's kind of hit its max, and it's time to kind of get out of there and maybe use those funds to then invest elsewhere.
Yeah, nice.
Yeah, I think the Beta Shares A200 and the Vanguard Australian Shares ETF, they're probably two good products to do a bit of research on, and they have similar names to what you've got there.
Is there an iShares version as well? I'm sure there is.
There is IOZ.
There you go.
There you go. For the sake of completeness.
Yeah, it's completeness.
Yeah.
So I think a few takeaways here, some winners.
Correct answers here, Alex. Come on, mate, lift your game.
According to Luke, a couple of winners in here at the moment: Webjet, James Hardy.
We like Webjet.
Webjet, keep that in there.
Like that.
Some COVID stocks. But I think overall, if you are to consolidate and sell off a few, there's the opportunity to reallocate into broad-based ASX ETF and pretty much get very similar exposure to what you have already.
Or a lovely active manager.
Nice.
But Sally, I think what Luke said earlier is the biggest takeaway from this. For everyone who comes on to Pimp My Portfolio, and for Bryce and I, there's always things we can be doing better. But the fact that you've started and the fact that you're in the market is so much better than not getting started at all. So well done on your journey to date, and hopefully we've given you some thought starters for the next steps.
Yeah, absolutely. Thanks heaps, guys. It's you pretty much kind of just reconfirmed my thought processes in some of those aspects as well. And like I said, ETFs were kind of on the card and on the list, and I'll definitely be looking a bit heavier into that.
Nice. Well, thank you for submitting today. We really appreciate you doing that and coming on and sharing your experience with the audience as well. So, Sally, all the best with it. Thank you so much.
Thanks, Sally.
Thanks, Sally.
Thanks, guys. Thanks for having me. Thanks for the info.
Now, if you'd like to submit to Pimp My Portfolio or would like to get in touch with Luke or any of the other advisors in our network, head to equitymates.com/advice and we'll make sure we put you in touch.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.